Maybe you missed this, but recently, Morgan Stanley downgraded its allocation to global equities from equal weight to underweight. Morgan Stanley chief cross-asset strategist Andrew Sheets stated that the most straightforward reason for this shift is simple. We project poor returns. And also, over the next 12 months, there is now just 1% average upside to Morgan Stanley's price targets for the S&P 500, the MSCI Europe, the MSCI Emerging Markets, and the Topix Japan. So, let's take a look. The S&P 500 is up over 19% so far this year and has reached record highs on hopes the Federal Reserve will cut interest rates in the coming months. But that fuel from the Fed may not be enough to help the stock market, according to Sheets. Sheets of Morgan Stanley stated that our concern is that the positives of easier policy will be offset by the negatives of weaker growth. He continued, we think a repeated lesson for the stocks over the last 30 years has been that when easier policy collides with weaker growth, the latter usually matters more for returns. In addition to weaker global growth, Morgan Stanley doesn't see corporate earnings helping much. Regarding earnings, Sheets believes the market is underpricing the risk that companies lower full-year guidance. Now, it wouldn't be the first time that Wall Street got it wrong. Based on information from CNBC, Morgan Stanley may need to put their plans on hold because the Federal Reserve deciding to cut rates can be a great thing for the stock market or a sign of trouble ahead, depending on the timing. According to data compiled by Fundstrat going back to 1971, the first interest rate cut by the Fed when the economy isn't in a recession leads to a stock market rally 100% of the time. Let me repeat that. Going back to 1971, the first interest rate cut by the Fed when the economy isn't in a recession leads to a stock market rally 100% of the time. Now, in my opinion, 100% of the time is a pretty good record. For reference, in the last two cycles, the Federal Reserve cuts didn't come in time. According to Tom Lee, Fundstrat managing partner and head of research, the last two rate cuts in 2001 and 2007 came too late. The U.S. was already in a recession. Tom Lee, who was J.P. Morgan's former chief equity strategist, said there are two ways to measure whether or not the Fed cut the benchmark interest rates too late. The first is to simply ask whether or not the U.S. economy is heading into recession. Of course, that determination is usually not certain at this time in the cycle. The question going forward is whether the central bank changed its tune in time to prevent a recession. Based on the level of the market indices, investors believe the Fed may be ahead of the curve. However, in Powell's recent prepared testimony to the House Financial Services Committee, he said U.S. business investments have slowed notably as uncertainties over the economic outlook linger, and that cross-currents have re-emerged. Many interpreted the comments to imply that somewhat more accommodative monetary policy had strengthened. And as with much of the recent economic data, it appears that uncertainties around trade tensions and concerns about the strength of the global economy continue to weigh on the U.S. economic outlook. So as opposed to the previous chart, if the Fed is late to the party, this chart shows what the effects of a Fed cut in interest rates would accomplish if we go into a recession. And now a blast from the past. This chart shows the comparison of 1987 and 2019. In both timeframes, the market rocketed from January into the summer. In 1987, the market began to break down in August of that year, and you can see the consequences. So the question is, are we headed for the same fate? Well, personally, I believe you should subscribe to this channel and find out. For today, That's ChewDog Charts. Thank you.